Is it possible to get a show of hands for all the people who don't know anything about Aqua? I believe Rohan is there, Siddharth is there, Muskan is there. They already are aware of what Aqua is. But there could also be a lot of people who have no idea whatsoever of what Aqua is. So we have one person who doesn't know. Tejal doesn't know about Aqua. Others, are you all aware of it? If not, just please just do a raise of hands, please. Okay, I think broadly people seem to be aware of what the strategy is all about. Okay, I'm assuming my screen is already visible. So I'm just going to take you guys through the basic details. So Aqua is the flagship equity strategy that we run on the PMS platform. It's a flexi cap PMS strategy, which means it can invest across large cap, mid cap, and small caps. There's no bias or preference for either of the market cap groups. What we do very differently in Aqua is that we take a quantitative approach to investing rather than an active approach to investing. And one feature that we're very proud of as a group is that this is probably India's only strategy that can change its investment style based on the market conditions and macroeconomic cycle. So, to give you an example, if you take any other PMS in India, every PMS house comes with a style bias. A style bias usually means that the fund manager might prefer a value style of investing over a growth or quality style of investing. Some other fund manager might prefer a quality style of investing. A third fund manager might prefer a momentum style of investing. So what we've seen based on data and market cycles is that none of these styles persist over a long period of time. They work for some part of the market cycle and then they change. And I'll actually give you guys a visual illustration of the same as well. So if you look at these charts, what is very evident here is, let's look at this chart in the bottom left corner. When my screen is visible, right? I'm just confirming once again. Okay. So on the bottom left, what is evident is I've taken two simple styles. One is quality and the other is value. And if you just look at this chart between 2006 to 2024, you will notice that there are some periods where blue, which is value, outperforms and does very well. And another set of time, the value style will underperform significantly and the quality style will do very well. And I think this whole pattern of switching between quality, value, quality, we've seen play out across market cycles. So the bottom line is you can't choose one investment style. Neither can you prefer to stick to one style all the time. We need a strategy that can change the investment style based on the market cycle. Even if you look at things like momentum and low vol, it is not necessary that momentum works all the time. In some cycle, momentum does very well. In bear markets, momentum does very badly. And therefore, you need a different style that can cut momentum. That is called a low volatility style of investing, where you choose stocks which have very low risk in the price movement, very low fluctuation in the prices. And I think we've seen this also play out. But the broad thesis, if you look here very carefully, is that bull markets are dominated by the momentum style of investing, but bear markets are dominated by the low vol style of investing. Even over here, I think what is evident is that when things are very good, people like to find value in stocks. They like to buy cheap stocks. But when things are not so good, like they weren't good in 2018-19 or 20, the COVID cycle, that's the time when people choose to buy or rather hide behind quality stocks. So it's very important to understand which market regime we are in and therefore choose the investment style. And I think this feature itself, which gives us four things, right? The ability to change our large cap, mid cap, and small cap allocation, which makes us size adaptive. The ability to change our fundamental investment style between quality value, which makes us fundamentally style adaptive, the ability to change our technical style orientation between momentum and low risk gives us technical style adaptability. And the final thing is the ability to switch between cyclical sectors and non-cyclical sectors. So it is called multi-dimensional adaptability. Why is this very important? You could have heard of many cases where fund managers are very clear that we don't invest in high beta sectors, we don't invest in cyclical sectors, we don't invest in PSUs. Usually, this is a very big constraint to any investment strategy because in cycles, when cyclicals are doing better, why shouldn't you invest in cyclicals? What are typically your cyclical sectors? Real estate, infrastructure, capital goods, metals, usually most of the PSU counters. All of these are more higher beta in nature than, say, sectors like FMCG, IT, healthcare, consumer durables. These are some of the lower beta sectors. So Aqua gives you the ability to change between cyclicals and non-cyclicals with a lot of ease. So I think that is one important premise of the strategy, that we are not only flexible in terms of our market cap choice, also in terms of our styles and sectors. And again, very important to notice that the way we construct our portfolio, we try to evaluate first as to which market and macro regime. So when we take macro regime, for example, we're looking at very simple things, right? Is the economy expanding? Is the liquidity expanding? This is basically an expansionary macro phase where you should have a higher risk appetite for equities. In contrast to this, we also have a contractionary macro phase where the economy is contracting or the liquidity is contracting. These are times when you should be more cautious of risk rather than just chasing returns blindly. To put this in clear perspective, so if we are in a risk-on market environment and an expansionary economic or macro regime, we would choose growth and value styles of investing. We would have a momentum tilt in the portfolio. We would have deep cyclicals as sectors that we prefer. And our portfolio would be tilted more towards mid and small cap. The portfolio beta would be high. But as the cycle evolves, we move, say, we go from risk on, where the focus is on returns, to risk transition, where the focus changes to risk adjusted returns, which we call as Sharpe ratio. And finally, when we go to risk off, the focus is neither on returns nor on Sharpe ratio. It is purely on drawdowns, or what we call risk. We want to reduce the amount of drawdowns in the strategy. So in a phase like this, we go to extremes. We go to quality, we go to dividend, we go to low volatility as preferred styles. We invest in non-cyclical sectors. We have a lot of large cap exposure. In extreme situations, we also have cash exposures. And the portfolio beta is ridiculously low because the idea is not to earn returns, it is only to minimize risk. And over the last 4 months, I think across all my interviews in media and print, we've been very, very clear about the fact that we don't want to focus on return maximization. We rather want to focus on risk minimization. So we launched the strategy in June 2023. So the period between June 23 to June 24, for 1 year, the focus was on maximizing returns. We had a value and momentum tilt. We invested in cyclical sectors such as real estate, infrastructure, capital goods, defense, high beta financials, engineering companies. These were automobiles. These were some of the sectors we focused on, and power. These were the sectors we focused on. And the portfolio was slightly more tilted towards small and mid caps. And the beta was high. In the first year, when we ran this strategy, we generated roughly 76% absolute returns, which was an alpha of 38% versus the benchmark, which means 2x the benchmark return. After June, our strategy shifted gears. We moved out of some of the deep cyclical sectors, started increasing the allocation to shallow cyclicals and non-cyclical sectors to reduce the portfolio risk. We increased the mix of large and mid caps, reduced the mix of small caps. We switched our investment style from value momentum to quality and low volatility. This was again to shift focus from return maximization to risk minimization. So the whole idea of this slide is to tell you that there is no strategy where one size fits all approach. You will need a strategy that can change itself, that can adapt itself to the evolving market risks and macro conditions. A couple of other things, just basic things that you all should know before meeting investors is that the focus of this strategy is on alpha generation. We use a quantimental process where we combine fundamental, technical, and macros into the investment process. A recommended investment horizon is 3 to 5 years, though there is no lock-in period. It's just a recommended horizon. The minimum investment is, of course, 50 lakhs. It's an open-ended fund where investors can come in anytime, can go out anytime. The benchmark is the broad market index BSE 500 TRI, Total Return Index. Our investment universe is top 500 stocks by market cap. On this universe, we eliminate 100 stocks based on liquidity and 100 stocks based on fundamental red flags, so that it's a much more cleaner and liquid universe for us to invest in and make returns out of. We are not trying to capture returns out of penny stocks or micro caps here. It's a top 500 universe, which is the most liquid universe in India as of today. Even from that, we eliminate 200 stocks, so we're left with 300 stocks as such. Finally, the number of stocks in the portfolio will be 25 to 30 based on the proprietary quant process that we follow. I'll take you guys through that. And at the time of entry, the maximum amount we allocate to a single stock is 4%. This is part of our risk management principles that we neither want to be over concentrated nor be over diversified. We want to be optimally diversified. The team behind AQUA is a very, very unique team of statisticians, risk analysts, Python programmers, macro analysts, data scientists, fundamental analysts, financial engineers. So it's a very strong and unique team that has worked behind the scenes on building AQUA for the last 3.5 years. And of course, all our models, goes without saying, do blend in the 80 years of expertise and experience that PL as a group has built. So I think I read something very interesting 3-4 days back, that computers on their own have no intelligence. Computers cannot think. So what we need is a strategy, which I'll take you guys through that. We call it a man with machine approach, where the human or the man brings all the wisdom, the intelligence, the logic, the understanding. But the machine brings the rigor, the discipline, the execution, the calculations, and basically eliminates all biases. So the man with machine approach is a very, very powerful combination in today's times, where you're retaining the intelligence, but also getting a lot of discipline and rigor. And the biggest advantage of this is you're free from all emotional and behavioral biases like greed, fear, hope, regret, FOMO. All of these things harass all investors, traders all the time. But an approach, a scientific and systematic approach like this, basically gives you that edge. Another thing that I want to highlight is that since we've launched the fund in June 23, our absolute returns for the period of 15 months ending September 2024 has been 87%. So that's a very healthy return for investors to get in 15 months. So investors who started with, say, 1 crore rupees currently stand at roughly 1.87, 1.88 crores. Net of fees, net of everything, net of costs, transaction costs, fees, etc. Venel, you want to pitch in?
Sure. So as Siddharth, I think, has mentioned, the focus is to navigate between themes. The focus is to navigate between asset classes, styles of investing, beta, and investment tilts. That is the essence of the strategy. That the it's not bound by a single variable, and we are able to move across these variables and create the best portfolio for the investor at a point in time. And this is where the strategy stands apart from all the other strategies that active fund managers bring to the table. Their strategies are focused on a particular way of managing money and not really.
I think, Venil, we've lost you. I think we've lost Venil. I'll take it over. Just a couple of key features that you need to be aware when you guys are understanding and talking about Aqua. This strategy believes in periodic rebalancing, which means this is not a buy and hold strategy. We rebalance the portfolio once every 2 months. The reason we've chosen 2 months is that we don't want to align with the quarterly cycle where most of the mutual fund houses also rebalance. And 1 month as a period is very short. It doesn't give the portfolio time to breathe. So we've chosen 2 months as the period, and based on all our historic back tests, we've realized that 2 months is a sweet spot in terms of increasing returns, being agile enough to manage risks, at the same time keeping your rebalance costs fairly under check. The moment you go to a 1 month cycle, your rebalance costs start increasing. So a 2 month cycle gives us that little midpoint to balance agility, returns, costs, etc. And something else that we really focus on is whenever we talk about a quant strategy, a big highlight is that quant strategies are usually having a higher element of repeatability in them because these are run by rules, processes, models, and data. There is no subjectivity. It's 100% objective strategy, and therefore, objective processes are running again and again for you, which gives you repeatability across cycles. The other feature that we highlight is that our returns are coming from an equal weighted portfolio of 25 to 30 stocks. When we say equal weighted, which means at the time of entry, every stock has the same weight. So if it's a 25 stock portfolio, every stock has a 4% weight. If it's a 30 stock portfolio, every stock has a 3.33% weight. So running an equal weighted strategy gives you the advantage of diversifying risk and sources of return. And why is this very important? I could have generated 87% return with a portfolio of 10 stocks, which is highly concentrated, but that is not repeatable. Generating returns from a portfolio of 25 to 30 stocks, which are equal weighted, is more repeatable in nature because your returns are granular. They are divided across stocks. And a strategy that can generate returns along with granularity is usually more repeatable as opposed to a strategy which generates returns with a lot of concentration risk in it. So we are providing investors benefits of diversification and repeatability. Finally, one thing which is important to understand is that there are no fund manager biases here. And the most important thing that wealth clients prefer is having benchmark agnostic strategies. Benchmark agnostic means our portfolio is no way related to the BSE 500 in terms of the weights of sectors, the weights of stocks, or the weights of market cap. Usually, traditional benchmarks have, say, 30% financials, 15% IT, X% consumer, X% healthcare, etc. Our portfolio has no bearing whatsoever on which sectors have what weight in the benchmark. For example, we ran a 44% weight on average for the first 12 months or industrials. Industrials covers your cap goods, defense, railways, engineering, all of that. But the benchmark weight was only 10%. After that, we reduced the weight to industrials, increased the weight to automobiles. Auto weight in benchmark is roughly 12%. We ran an average 22% weight. IT and private banks, I think they were the biggest laggards between the year June 23 to June 24, the biggest laggards in Indian markets. We had zero weight to IT and private banks. But after June 23, we gradually took up our weights to IT to roughly around 8 to 9%. So just because some stock or sector is in the benchmark with a certain weight does not mean we own it. We own it only if the merits or the quantitative scores and parameters suggest that it's important to own it right now. We'll take a little breather and try to get in questions from everybody who's attending. Any basic questions would really, really appreciate if you guys could put it on the chat.
Yeah, either you can put on chat or you can raise your hand and I will let you, speak.
Yeah. I think, Venel, given it's a limited forum of roughly 20 participants, we can also just open it up for everyone. Rucha,
Sure.
in case you're on the call, just please open the floor for everyone so it's more of a dialogue. While this is happening, I'll also take you guys through the investment process that we follow. It's a simple 3x3 process. It's a 3-step process. In step 1, which is broadly the top-down analysis step, we're trying to identify trying to answer 3 big questions. 1, how much risk can I take? 2, which style should I use right now? 3, which sector should I focus on? So we call it systematic risk assessment, detecting the style regime, and ranking all the different sectors and themes. Once we've done this, we have a very clear picture that, okay, I should take more risk. I should be pro equity, pro mid cap, pro small cap, run high beta. I should use a quality style or a value style or a momentum style or a mix. And I know which kind of sectors I should focus on. Once this is done, we go to the next step, which is the bottom up portfolio construction. In this, again, there are 3 simple things we do. First, it's called security elimination. So we are simply removing the weak stocks. I already told you guys, we remove 100 stocks based on weak fundamentals and 100 stocks based on weak or low liquidity from the top 500 universe. In the second step, it's security selection. It's simply choosing the top stocks. So how do we choose the top stocks? Every security or every stock gets a style score, a sector score, a risk score, a fundamental score, a technical score, and a valuation score. Those stocks with the highest total score come into the portfolio. Once we have decided that these are the top 25, 30, we simply allocate equally based on all the rules we've set to these stocks. And in the third step, it's all about managing risk. So how do we manage risk? Firstly, the periodic rebalancing gives us the ability to change the investment style if needed, perform sector rotation, manage risk by adjusting asset class mix, market cap mix, or beta mix. Second step is we have score-based exits. I think this is, again, a very important feature. Usually, fund managers find it very easy to enter a stock, slightly difficult to hold the stock, and extremely difficult to exit the stock. So we have solved this problem by creating an objective score-based exit model where the moment the total score of a stock falls beyond a certain threshold, it automatically moves out of the portfolio. So we don't need to use our brains. We don't need to let our biases, our attachment, our emotions to do with a particular stock come in between. We, as a quant fund, are absolutely we're not attached to any single stock or sector. We don't prefer it. We don't like some management. We don't dislike some management. We don't love private banks. We don't hate PSU banks. We don't hate real estate and infra companies. We don't love IT and consumer companies. We have no feelings whatsoever. And that is the biggest edge of a quant strategy. For the stocks that continue in the portfolio, we book partial profits every 2 months. For example, say we've got BSE. We started accumulating BSE at around 700 rupees. We held it till 2,600 rupees in the first cycle of its rally. Every time we owned BSE, say we started with a 4% weight, the stock rallies goes to 6.5, 7% weight. In the next rebalance, we will bring it back down to 4% as a part of our risk management principle. And then again, let it rally and again bring it back to 4%. So the stocks that continue, we keep riding them, but we book partial profits on a regular basis. And the final third step in terms of managing risk is our strategic cash call. What do we do here? Is based on our macro and market risk models, we try to protect the portfolio by changing the overall asset mix by creating 50% cash. This doesn't happen too frequently. This has happened probably 10, 12 times in the last 18 or 19 years. So it's not a frequent occurrence, but this is only to shield the portfolio in extreme macro and market risk scenarios. So far in the last 1 year, 1.5 years, we've not taken a single cash call. This is the performance of the fund. I think the big thing to understand here is that we've been quite consistent in generating alpha. The alpha percentage is also very healthy across time periods. Our quarterly performance has also been quite healthy, barring 1 or 2 quarters. Overall, if investors expect returns north of 20 to 25%, they would be very satisfied with a strategy like AQUA, because we are currently operating at roughly 60%, 62% sort of since inception CAGRs. But assuming things normalize over a cycle, our back-tested returns suggest that this is a 30% plus CAGR strategy. Venel, you want to add a couple of things here now if your video audio is
Done,
working?
done. Yeah, sure. I think the good part to highlight here is the quarterly performance. If we look at individual quarters, we are now in the sixth quarter. All the first 4 quarters, we have made sizable delta with respect to returns versus the benchmark. In quarter 5, we had a mild dip, and in quarter 6, this is till 30th September, but in the first 10 days of October, we've again managed to claw back 3% alpha over the benchmark. So this is a strategy which is inherently focused on generating alpha for its investors. And the way to look at it is over the next 4 to 5 years, if we are expecting economic growth in India to be around 9-10% at the minimum on the nominal basis, corporate earnings to grow at 13-14%, and Nifty earnings to grow around the same level, then this strategy should be able to deliver at least 700-800 basis points of alpha on a consistent basis over a long period of time. I'm saying this is validated by our back tests. Whenever there have been 3 or 4 years of rolling returns in excess of 15-16%, this strategy has given returns in excess of 25 to 30%, and we expect the same to continue. And Siddharth did mention about, that last 3 months, our portfolio has taken a capital preservation stance. You can see in the regime shift that has happened, the middle 2 charts, you will see that on the fundamental side, we have moved away from a value-focused regime to now a pure quality regime. And on the technical side, from purely momentum, we have moved out to low volatility regime. What that indicates is that this is a cycle in the market where it is important to preserve capital rather than chase alpha. And our portfolio returns, which you saw in the previous quarter, which appeared that they were slightly lower and now have again caught up, that is in a sense a result of this defensive stance that our model has taken. So that you can slightly scroll up on the same slide, just a little. Okay. So if you look at the risk profile as well at the bottom, right, you would see on a 1 year basis, strategy returns have been 61% annualized with a volatility of just 21%. So for similar volatility to the benchmark, we have generated nearly double the kind of returns. And that just shows in our Sharp as well, which is at around 2 for this period. Some of the stocks in our portfolio which have made money for us in this last 1 year and 3 months. Some of these stocks would have been in our portfolio for 6 months. Some of them have been there for 8 to 10 months. Some of them could even have been in the portfolio just for 2 months. But on the basis of these stocks, what the one thing you can see is that returns have come from a variety of sectors. They've come from banks, they've come from oil and gas, they've come from mining, shipbuilding, aviation, finance. You name the theme which is done well, and we would definitely have participated in that theme in the last 1.5 years. Next slide, please. And
I think we
Siddharth,
already covered this, right?
yeah, Siddharth, I think already covered this, that we went from 43% industrials a year back to now 0% industrials. That for me is the key highlight of this strategy, the ability to navigate through times with absolutely no bias is illustrated in this chart. If you look at the first six rebalances, there's hardly any consumer stocks in our portfolio. I mean, consumer staples in the portfolio. And in the last rebalance, we now have almost a 17% weight allocated to consumer staples. I don't think that any other strategy on the street will be able to offer such a dynamic approach to portfolio management. And that is the real strength of our strategy.
I think we've covered
most of the things. Yeah.
Yeah. This again, I think is important, the probabilities of how frequently we outperform and underperform to make it a very realistic sort of scenario. Why don't you just take this one?
Right. So what this stat is essentially telling you is that if you stay invested with us for a year, so our backtest starts from 2006 and runs till 2023. On any day of this duration, if you had started and you had stayed with us for a year long, there was an 89% chance of you outperforming the benchmark. And given that our markets are growth markets, there was a 94% chance that you would have made positive returns had you stayed with us for just 1 year. The moment you go to a 3-year window, there is a 100% chance of you making not only alpha but also positive returns. So there has not been a single instance where the investor would have not made money on a 3-year rolling basis. And the average 3-year rolling returns have been around 26-27%. And between rebalances, 74% of the rebalances we have been positive in terms of alpha, and 26% of times we have been negative. And it would be interesting to look at our outperformance to underperformance ratio. So of the 74% times that we have been on a rebalance to rebalance basis, right? The returns have been far better than the losses or underperformance that we have seen.
I think we've taken through all the major points. Why don't we, sort of open the floor for questions? And also, this is just a sort of highlight. This data is still 30th June, but this is just to show you that our strategy has been amongst the top ranking, top performing strategies in the FlexiCap PMS category. So whether you compare it to mutual funds or to other PMSs or to other quant strategies, we've been in the top quartile in terms of performance. I think let's open it up and make it more engaging.
Yeah. So anyone who has a question, please raise your hand and I will give you an opportunity to ask the question.
You all can type in your questions, raise your hand,
Yeah.
anything is okay. I've actually, given everybody the permission to talk now. So whoever
Okay.
wants can talk,
Great.
right? Right. So everybody's has the permission to talk. So guys, please ask your questions because it's very important for us that I think all the people who've newly joined the PL team, Aqua has been quite a star product for us. In 1 year for a brand new product, we've managed to raise roughly 470, 475 crores in AUM in Aqua. And with all the new people who've joined in, Inder and uh, Vineet. I've just interacted with the two of you all as of now, but I'm assuming a lot of people pan India have also joined in. So your contribution in making this product a huge success in your regions, in your markets, in your client sets will be very, very important for us to take Aqua now from the 500 crore threshold to the immediate next point, which is roughly at 1000 crores, which we aim to reach there in the next couple of months. So all your contributions will be very meaningful. And given that PL has now the privilege of having a winning product in our bucket, we should do the best to capitalize in terms of AUM and market share. Yes, I think somebody's raised. Mehul has raised. Mehul, why don't you, unmute and just speak? I've given you the permission to talk.
So I was asking what would be the churn ratio of the portfolio?
So the churn ratio of the portfolio, on an average, every 2 months, there is a 40% odd churn. So roughly around 200 to 50% per annum.
Okay. Isn't it high?
Yes.
Isn't 40% would be considered high or not? Uh,
No. So
In
the
the
churn is
quant
high,
in the
but
quant world, this is a low frequency strategy.
yeah, quants
And
operate with usually 1000 through 2000, 3000% churns
okay.
because globally quant strategies have a weekly, daily rebalance. We are still on a 2 monthly
Okay.
rebalance. So that is why our churn is manageable. And usually, what we need to say is uh, when we have investors allocating money to us, they are giving money to us for the adaptability, for the performance, for the alpha. Nobody is coming to give us money. Okay, take my money, reduce my tax. People give us money saying, what, take my money, grow my wealth. That is the value add we are doing for investors, growing their wealth. Managing tax for them is their chartered accountant's job, not the fund manager's job. So you can keep this answer ready if anybody asks you.
I
Awesome.
think
Thank you. Thank
Bhavesh,
you.
yeah, I think Bhavesh has asked a question. Is it the right time to top up?
So in a strategy like Aqua, I would never, advise on right and wrong timing. The whole point of Aqua is that you don't need to time. The strategy itself does all the timing for you. So since 4 months, we protected wealth and generated alpha by going defensive. We took a tactical defensive call and did very well for investors. So investors in a market where they could have lost money in a momentum strategy or in a growth strategy, we became defensive and generated 4% alpha and roughly 10% returns even in challenging markets. So I don't think it's about timing the top up. It's just about staying invested, using every correction in the market to, build your portfolio, to add money to the portfolio. And I think given the recent correction and volatility, I think adding some funds to existing clients is always healthy in improving their long-term returns. So for the last 15 months also, some investors have made more money than others, even though they've come in on the same time. And the only reason for that is timely top-ups. So there are some guys who say started with 1, 2 crores, but every time the market saw 5, 6% correction, they simply added lots more. and they kept doing 2-3 top-ups. So now their returns are north of 87%. They are sitting at 100% returns also. But that is because of their vigilance of topping up at the right time, using market corrections to enhance returns further.
Yeah, fair point over there. Anyone else has any questions?
So, hi Sid, and hi Ranil. This is Inderveer here. One
I
basic, do we? I'm sure we compare our performance with other quant strategies. Do we publish that also? Or maybe is there what is the comparatively competition product for this? I don't know. I've not seen somebody doing as deep a quant as we are doing, so which is fabulous. But do we have any, when we meet clients, we talk to clients, are they asking for comparative analysis with other quant products?
Sure. So I'll just give you two quick insights on this.
Yeah,
First, quant itself is so new that when investors meet us, they are meeting us to diversify from the traditional funds that they've been exposed to. So usually their question is, how is your quant strategy doing versus all these other large active houses that I've allocated to for the last 3-5 years and underperformed?
right.
That's the first point of contention.
Okay.
Rarely have people come to us saying, okay, I'm a pure quant guy. Now show me the comparison between quant funds.
Yeah.
So, to answer your
Understood.
question, internally, yes, we do track our fund performance versus some other real quant funds. But for the market broadly, they are still tracking our performance as a quant strategy versus all the traditional PMSs that they've allocated. And if you look at traditional PMSs, they are occupying roughly 3 lakh crore ka market size in
Yeah.
terms of AUM. Our entire effort is to tell them, okay, boss, the moment you have a quant product in your bucket as a wealth investor or as a seasoned investor, you are diversifying your return stream from traditional managers. You are diversifying your return stream from benchmarks. Quant strategies have the power of giving you uncorrelated returns when it comes to traditional strategies and benchmarks. And that is the value add that we as a house can do. So always focus on pivoting the conversation to quant versus active and win that
Hmm.
argument rather than going deeper into quant A versus quant B versus quant C. Because at the
Right.
end of the day, the moment you are pitching quant to PL's clients or your wealth clients, try to ensure AQUA as a PMS anyways gets that allocation.
Right. Noted. That's a good point. One more question I have now. When we see regular PMSs versus regular mutual funds, obviously there's a difference between the concentration of the fund, and of course the weightage of the sectors and everything. Is there similar difference even when you do quant mutual fund and quant PMS?
No, I didn't get your question.
So see, when we do a regular mutual fund with a maybe now I'm talking about non-quant phase. There is a difference between the fund manager restrictions, fund manager strategy, the concentration of the portfolio between PMS is a more concentrated strategy, 20-25 stocks, mutual fund maybe 60-65, sector
Right,
weightages, a lot of other things they have to follow.
right.
Now, same way, when we compare, in the quant space between a mutual fund and PMS, does such differences also, surface when we in the quant space also, or it doesn't make a sense where make a difference when you are dealing with a quant mutual fund or a quant PMS? Is there similar kind of a comparison also in this space between a
So
quant PMS and a quant mutual fund?
got your question. So I think the way to look at it is mutual fund as an industry is slightly more regulated, slightly more restrictive, slightly more constrained in terms of how you can build your portfolios. What are the no-go areas? What are the minimum parameters you must adhere to? PMS, on the other hand, is got more flexibility. That is very certain because the ticket size is higher, the risk appetite of investors is higher, and therefore the flexibility is also higher. So PMS would be little more flexible. Mutual funds could be little more restrictive. but at the same time, quant-based mutual funds and quant-based PMSs as a category deserve allocation of clients. One more thing, very important, quant MF is not a quant mutual fund. Matlab, it is not a pure quant strategy. So
Yeah,
if you are interpreting that कि quant MF के products को quant category में डाले, so that is wouldn't be a right classification.
understood. Understood. Very fair point. Fair point. Yeah. Thank you so much.
Okay.
Any other questions, clarifications that you guys want? Yeah, I think we are good to go then. Thank you all for joining in. Have a good day.
Okay, guys, thank you so much. And really wish to, scale this up to the next 1,000 crores. Please, whoever you guys think are the right, fit for this product, have the investable surplus, have the risk appetite, definitely, approach them for Aqua and help us for this journey of 500 crores to 1,000 crores. Thank you. Thank you so much, guys.